Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for May 4th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. What an interesting week it's been. For the most part, at least in our row crops, we could, I think, begin to discuss how the bear trend that we have been in for the last several weeks has shown signs of stopping in places like wheat, maybe just outright reversing. Some outside markets that we don't discuss, or we discuss every so often, like cotton, we're limit up today. So some interesting things going on elsewhere in the world. Crude oil, tells a completely opposite story here, with a big break on the open and overnight price action. Highs of the week so far up at 76 in the front month crude, with lows down at 13. This is one of the bigger weekly candles we've seen in crude oil in some time. So you're seeing this big volatility everywhere. It's been a what was, in my opinion, kind of a quiet market, all of a sudden got interesting and exciting again. So let's begin today talking. Where do I want to begin? Let's begin with July corn. Why not? The break below $6, technical and psychological here in the near term while my chart loads up there. There we go. Again, we've been in a pretty steep downtrend, right? Just a couple weeks ago in mid-April, we were testing, the 200-day moving average. The talk of the town was breaking potentially out of 650. The downward sloping trend lines on the July chart that have continued to now cap price action. And what we were left with was a rally, or, an uptrend. I get, in terms of corrective nature, not so different than that period between December and, I guess it was just the month of just December. But then, we didn't hang out up there for too long, did we? Right? We reversed hard and fell apart down into a new low. The break below the upward sloping trend line, or that, triangle wedge-like structure that we had in the market, that upward sloping trend line from the summertime lows around the 580 figure through that $6 area low in March, that trend line break brings up an interesting resistance area, that I think arguably, we're heading back up into. Oversold here on the daily stochastic has, an RSI has now been unwound, or starting to unwind. Today was the first day back into, out of oversold conditions. And again, that trend line against the lows up around $6 is probably the next area of interest that this market is going to be hunting out, right? We found that as support in March. Obviously, 650 held as resistance, came back down, broke below that figure, coming back up to test it as at least as resistance if this market's heading lower is likely on the docket. 200-day moving average up at 650, 100-day at 639, 55-day at 622, 18-day at 611. Even reversion to the mean in the slightest, right, for corn would have us going probably back towards the $6 figure and a little bit above, because generally speaking, we are just very oversold, and I would say that needing to unwind that oversold condition is probably in the works. And corn's not even the most bearish chart, right, that we'll talk about today, or the one that had the biggest bear trend, I should say, right? Because wheat was battered down beyond, almost beyond belief in some cases. But when you look at wheat as an international product, you realize that the U.S. competitiveness on the global scale just isn't there when you consider where the currency is and how arguably expensive our crops had gotten this last year. But that argument may not hold, so much ground anymore, that we've unwound all of that premium that was built into some of these markets. Wheat being at, lower levels than where we were well below where the market began to build in the Ukrainian crisis premium. And certainly now we're going down into, the pandemic, not quite, not certainly nowhere near pandemic lows, but we're going back down into that pre-pandemic or that pandemic range, which until 2020 or over the last couple of years, wheat spent a lot of time trying to break out of the area in the market that we're coming right back down into, and have already tested the support, and we'll look at that in a little bit. But that daily chart for December, or for July corn, excuse me, to kind of get going here and take a look at the potential reversal that might be happening off of the lows. I thought it was important to at least take a look at this old summertime low, the 580 area. And if you look at a chart of December corn, it was the 540 area. Notice that December corn is now snugly below that. But I think coming back up to test that old support now as resistance, that's the path of least resistance, if you will, for lack of a better term. But it's certainly the just the ebb and flow of a market trying to discover price. July corn really failed to break below that summertime 580 area, the old support that this chart found. We certainly came down and filled gaps that you didn't want to see fill in a bull market. But now that the chart's cleaned up, now that they've actually pushed beyond the lows that the market had held and gapped up from, we could start using the word capitulation for the slide that I think we just saw down into this low. A little shocked it didn't make it more headway, I guess, in that slide, given how far down wheat had been pressed. But I think there's also something going on in some spread markets going right now that are once in a generation type of moves. For example, the Chicago wheat to corn spread in the July contract, it's widened back out to 55 cents, but this contract got as narrow as 33. The May contracts went to parity. Granted, May's going off the board, and there's something to be said for contracts and spreads behaving a little differently into the rolls for each prospective contract. But this is as tight as this spread has been in 30 years. This spread averages $1.60 to $2 wide. So this is incredibly narrow when you consider the price of wheat to corn. And I think when you consider the economy of corn over the last 20 years, things have really changed, right? There have been there's been plenty of alternative headways, into corn as a energy source, where wheat just does not have, alternative uses. But while energy demand for corn grows, and for any agriculture product grows, its demand or usage by, for feed and other uses diminishes, right? There's only so much corn. Now, yes, I get it. Dry distilled grain, does not, and certainly in crushing beans as well, the meal products, right? They still can go for animal feed, and there isn't that loss of utility. But any other usage, right, for the product is for the oils and the sugars and the other products that then are made into ethanol and oil, and biodiesel. Right, there is no other alternative there for wheat. So does that mean that we need to get used to corn maybe being a higher priced product than wheat? is it due to that utility? Well, I think the spread markets are certainly starting to question that idea, or certainly the price of each this year. That is, coming into question, right? And so I guess that, would leeway into wheat pretty well, but I want to take a look at the 4-hour chart of corn first, because I do think there's some technical things going on in the last 48 hours that are worth considering in both beans and wheat or corn that weren't there. The other day when wheat was reversing very hard, it would have been very easy to call this a low for all the row crops if everything was what's wheat now, 40 something cents off the low in the Chicago contract and 60 something, off the lows here we closed today in KC. If everything looked that way, I think we'd all be saying this is a significant low, right? But for right now, it looks very much like a short covering rally and a bear market rally in wheat, with a potential for corn and beans to, build some premium in a rather methodical way, maybe, right? Like if we see the same kind of grinding rallies and bull markets, so to speak, cycles that we saw over the last couple months, because corn and beans have genuinely just been in big ranges for the last several months to almost years now, with the exception of price action maybe the last couple weeks for some contracts like December corn. We've been in very big ranges, and it's been the nature of the trade has been 5 to 6 week cycles of bull and bear trends, just back and forth, right, going up and down in these ranges. Anyway, the last rally we saw, let's bring the chart up here. Last significant rallies we've seen have been very methodical and arguably very arduous for July corn. Okay, anyway, so the point being is that if we see this same type of price action, I mean, it's just one more bull market rally in an otherwise, one more bear market rally that needs to be considered and sold into. Now, there's a lot of talk as well, and people have been pointing out left and right, the correlations to 2013 on the charts. They're absolutely there, and and arguably fundamentals there's other things that aren't so different either, but you need to be aware that we still had bear market rallies, right? And they were considerably strong. And corn, I think I overheard my colleague Ted talking about 60-cent rallies in corn at around this time of year. Beans can extrapolate out, right, to a little bit bigger. And that was a decade ago, right? And that was in a decade ago's volatility and price action. Those swings could be much larger today. And we're not saying, right, that I'm not saying that means we're entering into a major, bull move again. I'm just saying that maybe even a 2013 bear market rally might even be a little bit bigger in this type of environment too. But that's yet to be seen, because obviously when we look at charts like the chart of wheat and the trends in wheat that we've seen over the last couple months, I think things have gotten, or the ability for the markets to get pressed, right, to extremes, and for us to sit here and look at these new extremes and scratch our heads and say, wow, we didn't see that coming, right? Or like, because many of the conversations over the last several weeks I've had with producers, particularly in the wheat markets, have been very, very, I don't want to say worrisome, but like that we're concerned that there's an irrational, right? Something irrational is happening, because there's a lot of metrics that say, hey, things have gotten overdone. And now, right, the price action in the last 48 hours, I think, is certainly suggesting that maybe some of that, what we thought was overdone, was in fact overdone, right? And in 48 hours we've unwound quite a bit of that. So all right, let's take a look at the chart of corn. The 15-minute chart and the first little move we have off the lows here. I mean, just right off the bat, it looks like a little inverted head and shoulders. But today we had a 50% pullback from the 569 low to the 592 new high of the month. There's a 50% pullback into 580 there, and we've got a reaction off of it. So if we continue higher towards 596, continue through to 560, or excuse me, 597, and continue through the $6 figure, that 608 area is a 50% pullback, or would be the 50%. Excuse me one sec here. Fix my mic. Maybe you can hear me a little better now. That 6808 area is a 50% retracement, for the month of April. I'm not saying you blindly sell it if we get up there, but I think it's natural for this market if we're doing, in a bear trend, right, on the bigger time frame. Just, even though we want the market to go higher and we may be bulls, just because we're a producer, that doesn't mean we can't acknowledge that this has been a market that's been trending lower since October of last year when we made our 705 high. Okay, can we go back up to those highs? We can talk about that narrative, but for right now, let's just discuss the trend we see on the charts, right? And if this is 2 steps down and 1 step up, and 2 steps down, 1 step up could take us up to 610 to 620, and hey, that's a 50, 60 cent rally off of the lows to start with. That's a good rally to sell into, and if this is a bear market, but for the time being in the short term, right, I think the chart has flipped here. We see 2 steps up, 1 step back. So if there's a chance to do reownership or to do courage calls or to pre-plan, future long positions, this is a good area to be thinking about that. And even from a spec standpoint, right, I think that you can look at $6, end of week calls next week. Pull those up right now just to take a look at. Let's see here.
So, if for whatever, if you have like a 15 lot that you only want to show 2 at a time, and it doesn't have to be divisible by that number, right? Because 15 divided by 2 is 7.5. Well, what it'll do.
So end of next week,
and then the last one it'll just show
$6 calls. I'm guessing there'd be like 5-6 cents maybe. Yeah, there you go. The ask here into the end of the day was 5 3/4. They traded 4 3/8 last. I bet you could probably get these done between 5 to 6 cents, which I think for an option that is 12 cents out of the money right now through the end of next week, gets us through a report too. That's a great way of saying, hey, maybe if by the end of the next week we're above $6 corn, I want to be long it, right? And I do think there is an opportunity here for the market to get to 620 to 630. I don't know about by the end of next week, but I think that there's maybe 6 cents for the 5.95s is a better prospect, but because that's just through the highs of the month. I would do that instead, actually, because then $6 you're basically break even. There you go. That's an idea for into next week. But point is that I think that there's a little bit of reversal here on the chart that's occurred. There's also a downward sloping trend line that we had been holding. We got above it. We then had a little bit of a fake out. An outside day, or we were doing higher highs and higher lows to start the month. Then we had this capitulation, went down to hit the new low, make a new low for the month of April, tag the low of April, new low beyond the low of April, and a new low for May, which I believe will now be the low for May, as then we kind of retrace April higher. $6 is then, your first resistance with then, I think, really above that. I think getting back to testing this 640 to 630 area and this other high here at 650 would be interesting. And a full 50% retracement from 705 highs down to the 569 area is around 636. So I think at a minimum, the market should get back to the 610 to 636 area throughout the month of May here. And whether or not that is a great, rally to then sell into or not, that's another question. But I do think in the meantime, right, we've at least flipped the script on the very, short term. And I think this 570 low is probably pretty important for now. but the closer you get to 650, I think the stronger that resistance gets. Right, there's downward sloping trend lines. There's big fibs up there. There's technical reasons. There's, and I think then to, right, have a narrative that takes you back to contract highs. There's a lot of things that need to fall into place for that to happen. It doesn't mean you can't look for it, but putting your money, risking capital on the idea that that is going to happen is a risky venture. But at the very least, it looks like in the next, couple weeks to at least a couple days, the market is gearing up for a little short covering and to unwind some of the selling pressure we've seen. So, okay, let's move on to soybeans here because we got a lot more to get through and not a lot of time to do it. Well, we got plenty of time, but time always slips away in these things. Doesn't seem like we ever have enough time to go over everything. So, July soybeans, still very much in their range. I was talking about that range in the market in row crops that we had seen, with the exception of wheat over the last couple months that's fallen apart, and beans and corn, over the last couple weeks, where we kind of went down to test new lows. Soybeans have really been inside of the same range we've been in going back through March of 2022. So $14 is a pretty big figure here that we continue to hold. Upward sloping trend lines continue to confer that is, generally where that support is. We came down, got oversold here in that stochastic RSI. We unwound it. We made a new low for the month of May, just beyond the low for April, just like the corn chart. And now any kind of reversion to the mean, I think minimally takes you back to 1450. I mean, that's just the 18-day moving average. 200-day moving averages is 1457, 55-day at 1468, and the 100-day at 1483. Here's my crux on corn and beans. I think corn has more bullish potential right now because I think we overshot on acres. Whether those acres flip to beans or where they go, that's another story. Beans, I don't think we're going to lose too much in the way of acreage. I don't think we'll necessarily get. We probably will gain some from corn, given just where pricing is and input costs and other things. For some areas of the country, just some places input costs have come down, others they haven't. It's really regional. But generally speaking, input costs are lower. But I think the beans here are still right above, where they're at can represent some good profitability. Anyway, moral of the story there is that I think beans are very content with where their price is based on this range. I think supply and demand for soybeans, and also, by the way, right, that second crop in South America is a corn crop. Beans are done until we, begin our harvest in November. I think that's what's keeping them up right now, where wheat and corn have really gotten knocked down. But I also think that their ability to rally beyond 15 here in July and in November, that's going to mean, beyond. I think we'll get back to beans in the teens here, but beyond 14 in November is going to take a lot at this point. It's going to definitely take some weather events. But I think we can build some serious weather premium. I think getting back towards the median of the range for November beans, 1350 would probably be somewhat of resistance by now, but back towards 1326 is not out of the question. So that's kind of where I'm at, right? Like, we're still very range bound. This is the low end of the range trading. And I'm looking for that reversion to the mean in the beans. But going beyond that, I think it's going to be very hard, right? I think beans have a very strong magnet to the middle of their range right now. I think supply and demand, I think the globe is very content with where that is. Otherwise, we would have fallen apart, I think, a little bit more than we did. And then certainly earlier this year, I feel like when we were seeing strong exports and these other things, and certainly weather in South America, I thought we would have gone a little higher than we did. Well, both the situations are proving beans are content right where they are. All right, so July soybeans on the 4-hour chart. It's not much to say about the daily because it's 1540 to 1400 until it's not. But like the soybean corn, bring up the 4-hour chart first. Like the corn, we broke downward sloping trend lines here. Broke above them. Okay. Market then came down and made a new low for the month of May. Hit a new low below April. Hit stops capitulation. 50% swing for May at that point. From high to low. We've come up and tagged that 6-18 line up here at 1421. Once we did that, the 50% from 1392 to that high traded today at 1407. There's an upside target of 1429. We get to that upside target, we're starting to break above any other kind of downward sloping trend line in this chart. Call into question testing the highs of the month at 1440, and then all of a sudden now you're tracing the full 50, a full retracement, or the full range or the full leg lower is what I was trying to say, and because at this point it really is, you're just retracing 50% of the range. So but point being is then okay, now at 1450 and then above there, where does it stop until you get back at the highs of the range, right? Because this has just been a big range until it's not. So that's what I'm looking out for. While we're above 14, I think that's my line in the sand still here on July beans. I think in the very near term, I think 1410 is your supportive area. Really, we could retest there tonight again, I guess, if they want. But I think we'll be testing 1430, in my opinion. I think tomorrow and into the end of the week and next week, we shall see what happens. That would make me a little bit more bullish here in the near term. All right. So corn and beans maybe making a little bit of a reversal off their lows. I think that there's a reason to believe that on the technical side on the charts. And now it's up to the market to prove itself. Chicago wheat 645 here into the end of the day, up 5 1/4 cents. KC wheat up 13 1/4. Been a very, very, very arduous sell-off in this in this wheat market. I think we finally had some capitulation here. The short covering that we just saw finally took us out of, for the last 2 days, took us out of oversold conditions in that daily RSI. Excuse me. 18-day moving average is not that much higher here at 662. I think we'll be getting up there. It's also the old lows from March through May. 55-day moving average there at 697. 100-day up there at 629, and the 200-day at 790. $8 area. Any one of those levels, man, I just, but each one of them aligns, perfectly with some old lows and highs. But okay, above the 18-day, 730 is, I think, the real next level. Obviously, $7 is psychological, but I think we'd get up to test that 100-day moving average. And then the level that I think flips and changes the script for wheat at this time is back above 775 to 790. This old low that we broke below in August, and then have kind of failed, every attempt to rally there through this year to break back above, and then we started a new downtrend. That new downtrend, though, has seen its first short covering rally here in a month. And the last time we had a pop of this magnitude, we went sideways for a bit. So maybe I think the downside on wheat is over. Question of how high can it go is another question. And then of course is this you take a bigger step back on wheat, you look at the continuation chart, and you realize that wheat for a good amount of time here, wheat struggled to break above, the $6 area. Basically, the last time we came down here into 2016 to 2018, 550 high, then a 594 high, then a 5,892 high, and then we finally broke above that, tested it as support 572, 599, 601 again, and then went higher. Now we're coming back down to that whole area that we spent 3 years to break out of, and then year and a half testing. Um, we'll see what happens, but we've unwound quite a bit on this chart, and from the larger perspective, it makes things interesting. Now, before we go too far into wheat, I will mention the dollar is lower, in its trend off of the highs as well. It's been interesting to see the dollar basically falling, kind of alongside wheat falling, but that's going to help make wheat, more competitive here. So that dollar, coming down in value, will make our wheat a little bit more competitive on the global market, and that'll help with exports and everything else. Probably, be a big reason that we continue to find a footing, when and if we do, which maybe this is it. We will see. But the dollar index, in the near term, the June contract here, 105.32. That's a 200-day moving average. It's also old resistance here through January that we found. Yeah, we could maybe get up there, but I think we're going to probably be capped by about the 50% from 105 down to 101 at this time, around the 103 to 102 area, and that's where the 55-day and 100-day moving averages are as well. So I think the dollar index will be generally capped here, which should help and continue to support wheat markets. KC wheat, and then we'll get into the 4-hour charts for wheat. A little more bullish than the Chicago contract. I mean, we are 60 cents off their lows there, 8.14, and I was really looking for that close above $8 today, but I think that ignites things again, because that was the old figure here, right, that basically since July of last year we fought to break below. If it can't stay below 8, I think we're going back up. I mean, the range takes us back to the 200-day moving average, right? That's 870. So I think KC wheat should be able to get back towards, at least the 850 area, towards that 100-day moving average, and the 55-day moving average, which are around that 824 and 830 area, respectively. So, but yeah, some short covering here continues to be the name of the game into a long weekend where, God forbid, there's more escalation in Europe, but just think possibilities. So this downward sloping trend line and trend channel that was for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days straight and week has finally broken, and in just 2 days time we've already retraced at least 30% of that decline. 50% of this decline would take you up towards 660. Wow, we're almost there, right? The entire decline, though, in July wheat from its 949 highs there in last October down to lows is up to 775. There's big downward sloping trend line against the highs. This is just the July contract, so I see a lot of resistance back up towards $7. Of course, can't forget this swing lower. Shouldn't have taken the fib off of it. There we go. That gives you with that 670, 50% from highs to lows. That's also the old cluster of lows here from March through April. So I think there's a pretty good probability of the market in wheat squeezing back up towards 670. Does it go up above 680 to 690 to test 7 and break out and really start a bull trend? It's a long ways off, but in the near term, I was looking for wheat to pull into the 50% pullback from 603 to 647 highs. It was a strong move, right? Any big strong move, I'll always start putting fibs into, just to watch, and it didn't quite make it there, right? It front ran it by about 4 cents, and boom, off it goes. So it's even more bullish. It won't even give you a 50% pullback in that Chicago wheat, it looks like. KC wheat was not much different. Didn't do it, and boy, they're almost towards their 810 target. I would not be a seller here into the 50% area on the KC wheat at 810. I don't believe that range would hold. 110 highs to lows though are $10, excuse me, swing high down towards that 76 763 low, excuse me. 884 was the 50% there. Their downside target's 706. So a seller into that 50% area might be looking for a 706 downside target. Um, yeah, if we get above 810 and 830, we're going to be re-questioning that 880 and probably going to 920 and $9. We shall see what happens. It's a long ways off, but in the near term, by the dip, perhaps 50% pullbacks look like they're worth getting a reaction on. But I do fear that this is all a bear market rally in the wheat, and those short covering rallies can be very, very quick indeed and get faded even quicker. So be mindful of that. All right, well, that kind of wraps the major row crops. Worth noting here, though, before we move into the cattle and hog markets, and then we'll wrap up with some crude, bonds, gold, and S&P. Cotton limit up today after yesterday was a weird day. I wasn't sure why we saw that sell-off, but nevertheless, today we're right back up to where we should have been if we didn't sell off yesterday, basically, and that's what today was. But we closed limit up, so I don't believe we'll be expanded limits because I think it was just the front month future. I think it needs more than that, but we'll see tomorrow. Limit moves and of course expanded limits are always interesting, and how exchanges decide to and how those rules are. They're different everywhere, and ICE is no exception. So July cotton been a bit of a sideways price action here, kind of like our row crops. The only difference here is there's been generally at lows, but I think there's a lot of compression here that a move back above 85 starts to really creep up price for cotton, and I think maybe the world certainly is trying to needs to try to buy some acres here if anything else gets a rally, but the little bit of a spark higher here took us back above the 18-day moving average, which was good, but hasn't been much of a trend indicator in the near term because we've just been landlocked between 85 and 80 for some time. So I think right back up towards 85 in the high end of the range, cotton will go. Will it break out of that range? That's the billion-dollar question, isn't it? But that 200-day moving average up at 85 will probably get tested yet again. And after a limit up day, I imagine to see a little bit of follow through, into tomorrow. Not necessarily another limit up move, but to at least confirm and hang on to the gains of today. If they start to fade that away, then maybe today is a head fake as well. But at least technically on a chart, the last couple weeks of price action, so long as you're holding above 80, it's all just consolidation in the range, and a limit move within the range. Feels a lot like maybe one of these moves we had in March. Might go on for a couple days before it paters out, finds resistance and then rolls back over. But after yesterday's sell-off and today's sharp reversal, it does feel like we capitulated a little bit against the lows of the range, and now we're going to go higher here for cotton. December cotton holding up, far better relatively speaking on the chart. It's basically at the middle of its range for the last 2 years, but there seems to be something big about the 80 figure right now in cotton, and it doesn't matter about what it doesn't matter what crop you're talking about. The demand must be there, and from what I have spoken to with many producers, that they feel, that's about the low end of the threshold where they even, care to put a cotton acre in the field. And that changes the game a little bit, right? When, you've got producers who say, hey, these prices, I'd rather do corn or any alternative I can, because the risk is just, too great. But I know, right? We're all looking for and want to see $90 and $100 but we've got some significant resistance to chew through in ranges that the cotton market has been very comfortable in for the last, well, going on a year now. So we'll continue to be eyeing that, but limit up in July cotton. Again, question, calls into question the need to find resistance back towards the high end of the range. And I guess that's, one more tick in all the agricultural field crops that we have a move higher, going on altogether here. Ones that are at least somewhat seasonal. That can be, some truth can be said to that now. All right, so October cattle, not to, that I'm not looking at anything more near term, but, looking that far out, past the grilling season, how high, the market attempted to get, we still couldn't crack that 170 figure. And be that as it may, let's get June pulled up here. Okay. June cattle falling back down now towards a test of the 160 figure. There's a little gap, maybe down around 156, but more importantly, there's an upward sloping trend line there and the 200-day moving average. So we're right back down to testing the old resistance. All right, so the January into February found resistance in June cattle into this 160 area, 161. They fell back to the 200-day moving average. The trend picked the trade back up, drove it up to a new high. Now we're pulling back and through those highs, and now we're pulling back to test that area of old resistance, now support. We failed to kind of hold here the 55-day moving average. Let's use that as the line in the sand. We failed to hold that in the near term. You go down to the 100-day moving or 200-day moving average. At least that's what the trend has been in the past. If you see what I mean here, the trend generally stays above this 55-day moving average until it doesn't. And once it doesn't, it usually goes down to test the 200-day. So it doesn't, and it goes down to test the 200-day. The 200-day is where this yellow line basically would have been. But the point being is that a break below 161, if that follows suit, we could fall back down considerably. And it's really just where we were back towards the start of March. Okay. Feeder cattle in the April contract trading at 203 last. If you go further out in feeders, wow, 230s were trading out in September and such. I think that we're getting to the high end, right, of what this market can take in terms of it, and certainly you're starting to see the headlines now about packer margins and the decreasing herds. Well, but I mean that's why you've got prices for cattle where they are. All right, 18-day moving average still holding this market up here around 202. I think we slipped below that, right? It's also these old two highs. This 200 figure, we're going back down to test, towards 190, which is the old breakout figure here on the charts. It broke out, came back to test it at 192, coming back down to test 193 to 195 again. Maybe even as low as 190, that 200-day moving average not out of the question. So going to continue to look for some weakness in the cattle markets here. And, that alongside a rally in the row crops, everything looks seasonal right now. We'll see what happens. June hogs, they were trying to make a go of it. They broke above the 18-day moving average. Heck, even the 10-day moving average crossed above the 18-day moving average, which can be a decent short-term trend flip signal as well. But then we fell back down here and closed today below them. If we don't snap right back higher towards the 90 figure in June hogs, it's certainly, you got to stay above this 84, 40, 50 and change low. But if we don't snap right back up tomorrow and into the end of the week, unfortunately, this looks like a gotcha head fake, but I do think we're a little oversold in the hogs as well. But nevertheless, today's price action and the move back below the 18-day moving average was not what you expect if a market's reversing its trend and turning higher. It just unfortunately was not. All right, so let's move on. Let's take a look at crude oil. Because today's price action was, I don't want to say unprecedented, but, certainly if you yesterday, I should say, in it today, whatever. It's definitely what capitulation, looks like. Now, if we get followed through higher, you look at that candle and you'd say, oh, that is the easiest buy in the world, right? Yeah, well, it's $5. The lows of it are $5 away, which is quite amazing. But that is crude oil for you. So we have now, done the equivalent of this like move from 68 to 63, this wild whipsaw. I mean, that's no different than the gap up kind of whipsaw we saw that took, maybe a week to play out, but okay. So this market has now blown above, or head faked above the 80 figure, and arguably has head faked below, I guess, 66 or 68. I mean, it would be nice if it was 70. You could say the 70 figure nice and round, but unfortunately, it seems like we are actually trying to break below the 70 figure with how into the end of today's price action we failed to make any progress higher. Now, if we hang on up here, right? We do this little bullpen that we've been doing for the last half of a day. If we continue to kind of hold that, I think that there's a good chance that this is just the market taking a breather after one heck of a stop-driven slide down to the lows in the 63 handle. By the way, it was a new low beyond the low of March there. So you want to talk about dirty price action? I mean, terrible. But if we go back to November, we saw a day just like this where on November 21st, crude sold off from 80 down to 75. And then by the next day, we made it a high of 82, only to find ourselves, a week later, basically pushing down and into the end of, and into, I should say, the start of December, we were selling off down to, 69 again. So crude's a wild beast. I wouldn't I wouldn't use just this one whipsaw, big tail on a chart as a all end all be all signal for a low, but it's a good start. But as I just showed you in the past, there have been head fakes that look just like this. Head fake reversal candle signals, right? This looks like a textbook reason to be a buyer on crude, saying, "Oh, low's in place. Put a stop down there. Let's just write it right back up in the range, right?" But I'm fearful that the volatility in this market right now is creating head fakes everywhere. However, when we take a step back on that daily chart for crude, the 68 area, 68.07 exactly is the 50% level from our COVID lows up to the 129, 130 highs. So the market's just pulled back into 50%, right? It made two major steps forward since COVID. Now we've had a big step back. And if you're looking at crude, maybe that's a proxy for the entire inflation trade, right? We spent 2 years, everything reinflating and overinflating maybe, right? Past pre-pandemic highs, right? Even the stock market did that. And then now we've spent the last year, maybe year and a half now, deflating some of that, pressure that they put into the balloon. And then now the big argument is, right, are we finding price, lows in price levels that are not as low as prior lows? Some cases they're still higher than old highs, but there are new levels that we're getting used to, right? New support on the chart. Is there a reason for certain things to never go down to certain prices again, right? Yes and no, right? Well, we're at one of those lines in the sand for crude oil. I think if we start to break back below 68 to 65, you look back historically on a chart, this is an area where crude goes through major inflections. If we go below, we are into a very bear market, right? This is the type of market that can take you down to $30 crude. We've been there before. The last 20 years have seen this range trade many times. But it's also an area in the market where if we stay above it, could we be developing into a new price band, right? So as a technical trader, those are the objective things we're looking for, right? But there's something on either side there. And like I said, this whipsaw that we saw on the chart, this tail, it can be very indicative of low forming, but we only have to go back, 6 months to see where there was like a literal a literal example of a head fake exactly like this. That then, really didn't lead to a bottom on the crude chart for another month and a half before eventually, the market did trade at higher prices after that. But hey, even since then, we've been struggling to break above 82, which is still my line in the sand for, where I'll get really excited again about crude, is back above that level, that 80 to 82 figure. But I'm going to, I'd be lying if I didn't say below 70 and certainly below the 65 area, I have to flip my hat the other way, right? There, even on the macro chart, you have to start saying we're not in that super cycle for crude to go to new highs. That's just the wrong assessment, in my opinion, at that point. So it doesn't mean I think we will. I actually think we're probably getting closer to bottom in the near term than not. Seasonally, right? Going into the summer months, we look for this time to be a low, in my opinion, that then takes you up to a high into July and what have you. But the last few years, those kind of cycles and things have been weird because of various other macro stuff going on. Now that we got the Fed into a whole nother maybe news cycle, it calls into question, how are the financial markets and the financial sector is going to, and the cost of money just going to affect many of these things, right? And that's how we ask ourselves that when we're talking about the inflation trade and what have you, about how it's going to affect things. 132 on the bonds. We've been in a range 132 to 124. That range has tightened up, between 130, 4 and 129 now. But this is formidable resistance, until I think it's going to be I think we're going to really struggle to get through 132 until we actually see a pause from the Fed. Until then, the market is saying the status quo is acceptable, because we're neither going up or down. And I don't get where people are looking at a chart of the bonds and saying, there's a recession being priced in on this chart. Where? If a recession was being priced in, we should be 10 handles higher. We're not. This looks like a bear flag after one of the biggest rate rising cycles in the history of the Fed. I don't see where this chart makes me think, right, we're going to be going screaming higher. Now, we've talked about the downward sloping trend line in the past that we started to break above here at 132. And I don't disagree that this little bull pennant is still hanging in there, but it's been 3 months now. Things have to be getting exhausted. This has to happen or not. And this last Fed meeting was a great chance for them to pause, and they didn't. And I don't even think the rhetoric was enough to convince me to saying that the next meeting they're going to pause. I don't know. I just don't see it. I think the Fed got too much egg on their face with inflation, and I think they're going to still continue to overshoot it with this rate rising. And I think that will end up causing something, some kind of, maybe crises a little further down the road than people anticipate. But too many people are calling for recession. There's too many bears, or I guess there's too much doom and gloom out there that I think has already been baked into the charts that I'm just not seeing. Again, don't get me wrong, bank failures are bank failures, but these aren't the same type of bank failures we saw in 2008. It's certainly not good. They are liquidity, crises and can continue to exacerbate. But I think it's a recession of the banking sector, not a recession of the economy. And I think that's where there's a big difference here, because I think when you go around to your, in terms of look at the labor market and you look at, people might be living a little bit more paycheck to paycheck because prices of everything's up. But generally speaking, I think if you want a job, you can find one. This is not what 2008 felt like. I just don't see I don't see it out there in the real world. I definitely see the cause for concern in capital markets and what have you, but that's going to really just affect shareholders and of certain institutions and what have you than I think the broader market. Can it mean a slowdown in credit markets and a crunch to credit? Absolutely. And that's probably going to mean it's going to be harder for smaller and medium sized institutions to get access to credit. But we also live in a wildly consolidated world where yes, mid caps and middle America matter, but unfortunately everything has been consolidated to a few major conglomerates that um, if they have issues, we all have issues. But so long as you can still order things on Amazon or go to Walmart, unfortunately, um, and products are on the shelves there, right? Because hey, we saw during COVID how supply constraints can cause recessions of their own variety, right? And that's a recession to worry about. But that's not what's happening either. So anyway, I don't see it on the bonds. I see the bonds very content where they are. I think the Fed arguably has this market well tamed and under control right now. And I know nobody wants to hear that, and I'm probably the only one in the room willing to say it. But I actually think they're kind of keeping things. What they're doing right now, I think, isn't a bad idea. What they're doing 6 months ago was idiotic, and I think. But I think they're also going to continue to do this for a little too long, because clearly inflation hasn't been completely reversed, but things have cooled off, and the world is survivable, right? People's paychecks aren't going just being burnt out the door on eggs and gasoline right now, right? Um, that's the point I'm trying to make. So, what does that mean for the stock market? Really quickly here. Again, I think they're very content in the stock market right where we're at. We are sitting basically at the middle of the range for the last 2 years. If you want to think about supply and demand or the wrestling match of Bears and Bulls, they're very equally matched right now. So, I think everybody has a good argument. I don't think there's enough bull. I don't hear many bulls out there though. But I am at least one that is willing to say that, hey, I see the constructive nature of the price action that we're seeing, the levels we're holding. If we can push above certain levels, I think that it continues. But again, it's not much more to be said about the S&P 500 other than 4,200 to 3,800 is a range here until it's not. The next time down here, though, failing to break back below 4,000 would be key. That'd be a win. But then you need to see the market get above 4,200 for things to get interesting again. So. Anyway, that does it here today for our strategy of the week update there. Hope you've enjoyed the content. Next week we'll be we'll be talking a little bit more about what is coming up in terms of our next WASD report. This will be the first time that we get to see the USDA with give us some prospects beyond they're forced to use certain acreage numbers, but we get to see the balance sheet starting to come, being fully fledged out now. So it's the next kind of linchpin, right? In all of the analysts' numbers get to be pulled out now. So with all that being said, you can always reach me over here at Zaner at 312-277-0110. Find me on Twitter at DHussey or Daniel Hussey Jr. Dan SO2D right here on Facebook, or shoot me an email at dhussey@zaner.com. Leave your likes and your comments in the sections below, and be sure to sign up for the Strategy of the Week webinar or the Zaner Daily Newsletter in our the sign up sections in the information section and comment section of this video as well. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.